Good afternoon, Corey Schrader with Black Creek Wealth Management. Hope you guys are all doing well. Wanted to put out some timely information, especially with what's going on with just the general investment community, markets, interest rates, inflation, Ukraine, Russia. What else is going on, right? Today, if you've been watching, the news and the investments, especially CNBC, right? You would have probably noticed that they were a little bit honing in on the fear aspect of the world right now. So what I'm hoping to do today is to give you a little bit of some information to just make you aware of what's going on and ultimately be able to take the right steps that you feel you need to take in order to make sure that you're protected. You're also taking advantage of this environment, but you also understand what's going on. And really my goal here is to help separate the noise from reality, honestly. So what I'm going to do is I'm going to show you a number of charts. I'm going to show you a little bit around what I'm doing for my clients to make sure that they're protected because, at the end of the day, I want to make sure everyone I help are taken care of, especially when there's just noise in the system like this. So I'm going to go through a couple of things, primarily going to go through rebalancing, going to go through market expectations, interest rates, and just, again, give you a little bit of some insight into how we're looking at things and really, really help you out here. So if you've been watching and you just pulled up the news today or pulled up your 401k IRA, you're probably not going to be going out to dinner and having a grand old time tonight. Now, I say that assuming that you didn't have it positioned where it was incredibly defensive, all cash here over the last couple of weeks because you just didn't want to see any movement or fluctuation. What I'll tell you is it's not as bad as it seems, and I'm going to show you a couple of charts here to be able to help illustrate that. Because yesterday they had a very different tone on the news because there was a different tone yesterday. So what happened yesterday is Jerome Powell, who's the Federal Reserve Chairman, got on and talked about interest rates. We already know inflation is running pretty hot, specifically in food and energy, right around 8%. And really what's going on with that is there's a lot of durable goods or laundry, washers, dryers, dishwashers, cars, things you would normally buy. There's a lot of inflation based off of a lack of supply. Just a lot of people feel like they're doing really well. They want to buy new things. COVID helped us realize, hey, we need to do more things more often, just enjoy ourselves. Well, the United States is primarily, or has been primarily, a service-driven economy. Well, the problem with that is when you lock up all the services and now you want to start buying goods and you have supply chain issues, you're going to have a supply and demand imbalance, right? You're going to have a lot less supply and you're going to have a lot of demand, which tends to push prices up because you have a lot of money chasing fewer goods. And that is the whole basis of supply and demand. Now, there's a little more complex, but in its simplicity, for what we need to know, we need to realize that until supply chains get a little bit better, we're going to have higher prices. And the Federal Reserve knows that. That's why they talked about transient inflation. Now, it's running a little bit longer than they expected. And now that we have COVID in China coming up again, and they have a different approach, and politics aside, they're just having issues with their supply chain. So we just need to be aware of that. And we're constantly watching to see how deep is that going to be, right? So with what's going on there, you have some supply issues. Well, now we're starting to see where some of the service industries, the restaurants and those types of things, people are going out to eat now because we've all been released from lockdowns and mandates and these kind of things, right? So now we're starting to get back to our old life as service, but we've been locked down. So now you've had, if you've been to a restaurant lately, you've seen this. You've seen 2 or 3 servers. So companies trying to make the most out of less. This is just the way companies operate until the demand is high enough where they hire more people. Well, there's almost 1.5 jobs for every unemployed person out there right now. So people are talking about stagflation and all those kind of things. Well, one of the core principles with stagflation is you have to have high unemployment. We're at record low unemployment right now. So there's a couple of things just to be aware of with that is they're going to use buzzwords. They're going to have a lot of things out there that just try to drum up some level of emotion. Okay. What I'm telling you is that the economy right now is doing extremely well. People are delevered, meaning they don't have a lot of credit card debts. Yeah, they have a lot of excess money because the markets have run up 25%, especially those who have been invested, every single year for the last 3 years. So people feel like they're doing really well. And interest rates have been incredibly low, to say, as I always say, the wicked low. So that is something that the Federal Reserve knows you can't keep that going, because now you have a ton of money chasing fewer goods and you have inflation through the roof. So now we need to do something about it. They tried to do something back in 2018 and they didn't make the right call back then. And then, of course, we had COVID, which exacerbated that. So now they're trying to do the right thing and raise interest rates and get back to normalization. And normalization is usually around 3.5%. I'm going to show that here in a second. So what we're looking at right now is you have an economy that's trying to figure out, okay, there's not free money. It means I'm not going to be able to borrow. I'm not going to be able to take out low interest mortgages. I'm not going to be doing all these things. So growth rates on these individual stocks are starting to go to the point where it's like, well, what is growth going to be moving forward? And since the stock market is 6 to 9 months in advance, they're selling now and waiting to see what happens. It's just, this is the cycle of the markets. And that is what you saw today is Jerome Powell came out yesterday and said, hey, we're going to raise interest rates by 50. We're not going to do 75 basis points. And that's not even on the table because there was speculation about that. So it was very clear, concise. Here's what we're going to do to try to help out. They didn't have any sort of vague language. It was very clear, and they're sticking to that plan at this point. So if you watched yesterday, what you saw happen is the markets just skyrocketed up about 3.5%. Well, wait a second. The markets dropped 3.5% today. That's kind of random. Well, if you looked yesterday, you were happy. If you look today, excuse the expression, you're frustrated. I was going to say what I was going to say, but I'm going to say it. You'd be frustrated. And I get it. I'm right there with you. Like, I'm investing myself. Like, I would love to see calm seas and see 6 to 8% returns without having to worry about it. But that's not the stock market. The stock market is there to create fear and greed, and to be able to navigate it can be challenging, especially when you look at it at intermittent times. So the first thing I'm going to tell everybody, and this is so counter to most of my colleagues out there, they tell you, don't worry about it, just invest, and don't worry. Stop. Look at your statements. You got to know where you're at. Okay. You got to know what you're invested in. I know where my clients are that I'm investing for them. I know where they're at. I have the conviction of where we're going. In fact, I'm actually looking at rebalancing their portfolios here in the next day. I'm going to see how tomorrow plays out. And I'm going to show you why here in a second. But it's one of those things where now is the time where you separate the men from the boys, right? You want to do the mechanical things to make sure that you're doing what you can to separate yourself from the herd. And what I mean by that is when you look at your account and you see how you're positioned, you can see how far you've either gone down or gone up, but your investments get out of whack. Bonds are down almost 10% this year because they've gone from, and I'm going to show you that chart here in a second, they've gone from 1.5 to 3.1 or 1.4 to 3.1 here in the last 6 months. So they've doubled, right? So bonds have absolutely dropped. The bond bull market, as they call it, has changed. Not only that, stocks have also dropped, right? S&P 500 is down, I want to say about 12% year to date. So things are out of whack, right? So you want to go in there and you want to look at it and say, how can I modify my strategy or my asset allocation so that way when the market comes back, because it will definitely come back. When it comes back, you don't want to be underweight stocks because then you're going to be trailing the market because you didn't rebalance it correctly. So that's the first mechanical thing you can do. And then you're going to say, well, Corey, what if the market drops? Well, think of it from a strategy perspective. If you rebalance and you buy more stocks, and let's say it's a taxable account, and the taxable account drops, well, now we can go in there and look at, well, I can create tax loss harvesting and buy and sell on the way down to be able to take that tax benefit to use against future gains in the future. So I've basically created a tax deferred account out of a taxable account. And if you don't know what that means, you call me. I will show you how to do it. Okay. Because That's how you make money when the market's going sideways and down. Okay. So rebalancing is definitely something you got to do right now. And that's the top priority. Okay. Now, when you look at what's going on, and let me share my screen here with you. When we talk about what's going on in the markets right now, okay, I'm going to show you essentially what happened over the last 2 days. And let's go ahead and show you. So right now, this is the S&P 500, SPY, the ETF that 90%, I shouldn't say 90%, probably 70% of your average investor has in your 401k, IRA, all these kind of things. All it does, it's a basket of individual stocks that tracks the S&P 500 that just represents the top 500 companies in the US market. So let me just bring this to the last couple of days. So this is today. We opened right at about 424. The market got as low as so got as low as 409 and then closed out off the lows at about 413. So a pretty stretched day. And of course, like I said, if you looked at it today, you'd be like, oh my gosh, what's going on? Well, let's look at what happened yesterday, right? So Jerome Powell, we opened low at 417. We got as low during the day, about 413, and we got as high as 429, and we settled out at 429. So yesterday was a great day, right? We were super happy about it. But today, not so much, right? I'm not happy about this, right? And I get it. So I, for one, do not like to see any account drop. It bothers me. And I am fully aware that the market has its own mind. The biggest thing that I try to explain to everyone is that you will feel the pain of a drop twice as much as you'll feel the excitement of a gain, okay? So you could go up 2 or 3%. You'll be excited about it. But if it drops 2 or 3%, you're not going to be happy. And it's just in our nature. We love to see the upside. We hate to see the downside. And the biggest part of that when it comes to investing is controlling that emotion. And that is why when I look at this, I kind of take it in the back to understand, okay, how bad is it? And I always encourage everybody to talk about a reference point, okay? Now, what is a reference point? Well, let's say you started at $10. Stock goes from 10 to 20. You're super excited. You doubled your money. What do you do as soon as you do that? Well, now 20 is my new starting point, right? Well, if it drops from 20 to 15, I am not happy because it just dropped, right? But if you look over the time horizon, you still made a 50% gain from it moving from $10 to $15. But what changed was your reference point. You moved it from 10 to 20. So I always try to encourage my clients, like, I want to see it keep going up and up and up and up. But I understand that if everything goes up, it's eventually got to come down, right? Learn that in physics. Doesn't mean that it has to drop all the way back down to where it started. It just means that you need to be aware. And part of my responsibility is to make sure that we get as much as we can on the upside and I protect as much as I can on the downside. And we stair step this thing to success. And everyone that has a plan should have a magic number that you're shooting for. So are you shooting for 6% a year, 5% a year, 8% a year? So when you see a 20% year, you know that you've just bagged 3 years of gains. So you have a little bit of some reserve when the market corrects. So it's just trying to wrap your mind around it. But again, I'm not trying to by any means diminish the feelings that we have in days like today. I'm just trying to explain that this is normal. Okay. So Corey, if today was crazy and everyone's starting to sell again, why do you seem so calm? What's going through your head? Well, let me show you an interesting chart, and I'm going to move. So this chart here was a daily chart. This was today. That was yesterday. That was Tuesday. That was Monday. Wait a second. Let's look at something. If we go to a weekly chart, okay, let's look at this. The market's up on the week. Wait a second. We were down to about 411, 410 last week, but now we're up at 413. Explain to me how, like, something's going on. And this is what I've been trying to tell everyone. And I hope everyone's been reading my newsletters since January, because I've been talking about this, is the market is trying to essentially figure out where it should be. Okay. Now, I'm a candlestick guy when it comes to charting. As I continue to dig deeper and deeper and deeper into this, I start to see the value of it. And I'm not going to get into it. And if you want to learn more about it, I'll be happy to teach you. And I'm going to do it on my Trading Tuesdays. But this is the stock market over the last, couple of weeks, couple of months. Actually, yeah. So it's from July to right now. You can see where there's been heavy selling pressure, but yet we're starting to see this floor develop where it's starting to, and it's hit it one time here, it's hit it here. And if I expand, you'll see where it's actually hit it a number of times. And that's why I have the support level at 400. And that's 400 on the S&P 500. What is happening is if you think of an airplane landing, right? We got too high. The elevation got too high. And maybe we're running too hot on gas. So the plane has to come down a little bit. Well, at some point, because we are raising interest rates, we got to land the plane. And that is what's happening is the plane is landing, and it's been landing basically since November. So interest rates have been going up, 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 up. And now it's time where we got to start landing that plane so we can start looking forward. If we're going to take off, what is the winds? What does that look like? And that is what's going on is there is a floor. We are going to hit the floor. The challenge is the Federal Reserve's trying to create that landing to be as smooth as possible. And the biggest thing when you look at it is if you can keep in context the tightness and take out this year and just look at it time over time. We were at the beginning of COVID, before we locked down, the S&P 500 was at 337. It is at 414 right now. We are back to where levels were back in April of last year. Okay. So if we've been up 75% over the last 3 years and we give up 1 year, how much does that still make us up over the last 3 years? About 50%. We got to keep it in context. Okay. Now that does not mean you just own anything willy-nilly. You got to know what you're owning. This is my biggest thing for anyone in retirement, near retirement. We need to talk. If you do not know what you're doing, or if you have an advisor and they're not calling you, or you haven't had this conversation, you want a personal relationship, call me. Okay. Because I'm not going to let people in retirement just get obliterated. If you were in a freedom fund, the old, target date fund, they are getting obliterated. They are feeling such the pain. And when's the worst time you want to feel this pain is when you're in retirement. So if you don't have that person, I'm begging you, get the person. It doesn't have to be me. Make sure they're a CFP. Make sure they've managed money. I've managed money before. I continue to manage money for clients now. I've actually managed money. I'm not sending it off to an internal management like I did back in my old firm. So talk to somebody. You got to know what's going on because the regime, interest rates have changed. And if you're near, at, or in retirement, you got to know what to invest in. So I'm not going to go down that road, but that is where we're at. So if we look at where interest rates are right now, and like I said, they've gone up, and I'll pull this up here. So interest rates have gone over the last year. Okay. We got as low as, that's 3 years. So we got as low as 0.5%. Okay. We were at 0.5% at the bottom of COVID. And then last year we were sitting at about 1.2, if you remember, right around this time period, actually back in July. It was a little bit higher. It was about 1.4 to 1.6. Okay. So in the matter of a year, the market has doubled when it comes to the interest rate. But the market hasn't fallen 50% since then, right? It hasn't. So there's a level of stability that's going on in the market right now. They know interest rates are going up. They're selling ahead of this. And I'm going to show you here. Let me go ahead and just break it out. If we look at just where the interest rates have been over the last, since 1920, you can see back in the 60s and 70s where the interest rates just took off, man, all the way up to 13. Hell, people remember back in the 80s taking out a loan for 21% on a house. Forget that nonsense, or even, I think it was maybe 18%. I mean, you could get a 30-year treasury back then. Those people were not happy when they sold 10, 12%, having to settle for today's rates. But if you look at where normalized rates usually sit, they usually sit around 3.6 to 3.7. Now, this is the 10-year. So if you give your money to the government for 10 years, they're going to pay you out each year 3.67%. As of today, we are at 3.1. Okay. You can see clearly where the market went from 0.5% to 3%, we did not see an equivalent symmetrical drop in the S&P 500 or even a symmetrical drop in technology, growth stocks that take out so much debt that this interest rate would punish them. Now, again, don't go buy Roku. Don't go buy Peloton. All these fly-by-night, stay-at-home things that just took off. Look for good stocks. Look for good companies. You got to be in high-quality stuff right now. But again, we are basically at the normalized rate, or back where we were late 18, early 19. So even if we get up to a normalized 5%, so let's say we go 2 more percentage points, let's say we go another 50 basis points, and the market drops again, that would mean the S&P 500 and the NASDAQ would drop back to another, let's see, the NASDAQ would probably drop another 10, 15%. S&P would probably drop about half of that. So we'd be starting to tap into right after the COVID rally, okay? So overall, when it comes to interest rates, the Federal Reserve is aware that there's way too much demand for supply. And the only way to do that is to make it so tough that we don't want to go out and spend money and that we'd rather just sit on our hands. Well, COVID realized we want to take some trips and travel. So we're going to have some higher expenses. Now, this is going to be a little controversial depending on what side of politics you are. My belief is that I think corporations are absolutely taking advantage of us. They are pushing us to see how much of inflation we can absorb. Now, there's absolutely inflation, especially with agriculture. I know it's there. I believe in it. But I'm also a realist when it comes to running a business, and I would push my costs as far as I can to the point where people don't want to pay anymore. It's called elasticity of demand. If you don't have elasticity, it's called inelasticity of demand, meaning that you're not willing to change how much you're willing to pay for something. Well, I know I went to McDonald's and paid $15 for a double quarter pounder, thing of fries and chicken McNuggets for the kids. I'm not spending $20 on McDonald's. Not happening. So it's going to change my demand. So that's the long story short when I say interest rates. When you look at what's going on with the Federal Reserve, and again, I take this kind of tongue in cheek because we haven't seen interest rates being lifted like this in 40 years. But typically 12 months after the first Federal Reserve hike, you can see, and this is from Goldman Sachs, there's a huge rally that comes from it. 86, 94, 99. I'm still of the mindset that, yeah, I take this tongue in cheek. I think it's more of just the resiliency of the stock market. People enjoy making money. They know on average it ranges about 8%. Shame on any advisor that's been telling you 10, 12% on average. That's just not accurate. I think, and I've been telling people this, you're probably looking at 6 to 8% at least for the next number of years. So it just depends on how you manage it. But overall, the Fed is doing what they need to get us back to normalization. My hope is that we don't see any sort of anomaly out there where another war breaks out or anything else that would create more of a drop. The market, to their own detriment, is starting to talk about, well, if we start adjusting earnings for earnings calls, they're going to start adjusting prices down and people are going to start selling as a result of it. I think they're just looking for a narrative to be able to explain the drop today. I personally think that the economy or the market is saying, I want to see if that rally yesterday was real. And as of today, it basically is holding. It's holding at 410. And as a technical trader, that is a wonderful sign to see, because I know where that support level is now going to show. And I can actually profit off of that moving forward. Because if we have a lot of stability here, and anyone who does candlestick charting, it's called a doji. And all it means is you have such an argument, a battle, a tug of war between buyers and sellers, that they are so flatlined that usually tells us that, hey, there is enough of a fight that they don't know which way to go. So now we need to look for what is the next sign that's either going to take us higher or lower. And from my perspective, I think we're getting to the point where people are just tired. They're tired of the noise. They've seen it run down. There's not a lot of selling. And there's studies that show this. When you get to the point of just saturation of fear and just, I'm done with it, I'm just going to put my statement away and just not worry about it, we're there. So even if we were to drop another 2 or 3% and we're down 15% on the year, and I showed this in my last newsletter, let me see if I can pull it up here real quick. It's one of those things where you got to understand that the sequence of returns in general is going to play out here. So bear with me. I apologize. Let me pull this up from the trading newsletter here, because I just put it out. All right. And it's called my intra-year decline. And what I love about this, and this is going to be my last point of the day. Okay. So the market's down 12% today as of year to date. If I was to cover up the bottom here, and I used to do this with clients all the time, especially back in 08, you would pick, I'd say, which is your favorite year? And you'd say, well, all of them are pretty good, but I really like the higher ones, obviously, right? Okay, well, let's say back then, again, it was back in 08. So they'd say, well, I like this one, right? Back in 05, or I think, yeah, I'd have to look at it, but I think it's 05. And okay, well, we were up 20%, 27% that day or that year, right? Look at that intra-year drawdown. Think of that for a second. We were down 27% at some point that year, and we still closed up 27% that year. That means that was a 54% reversal on the market. Okay. Do you remember COVID? We were down 34%, rallied back 29 the next year. In fact, we still even rallied back 18 that year. Now, I'm not saying that's going to happen. What I am saying is that even in these years where we've been down 14, 19, 17, it's happened. What's been happening lately is since we got these little technology handheld computers from the early 2000s, we can check this stuff more often, more readily. So we're more aware. Well, if you go back throughout time, as I'm showing you here, the market's dropped on average 8 to 10% every single year. We're slightly above that right now. This is normal, but you got to know what you own. And if you don't and you want some help, reach out, call me. I am here for you. I created my own firm to be a private investment manager to serve people. So reach out to me. Let me know what you need, because I want to make sure you're taken care of. This is not the time to hide. This is the time to ask questions and understand what's going on. Okay. So that's all I'm going to go over today. I just wanted to make sure that I took the time today, and I, of course, am running long-winded because I love to over-communicate. But I am here for you. I really appreciate the trust. If you're following me, if you know anyone that needs help, feel free to send this to them. I want to make sure everyone is taken care of. And if no one's reaching out to you and you need a voice, give me a call. But overall, a couple of things to take away. This is normal. Know what you own. Start looking at rebalancing, and just, if you got a short time horizon and you're in, at, or near retirement within 5 years, you got to make sure that you're looking at the landscape, because that you're going to have a lot more uncertainties than people did about 5-10 years ago. If you're over 5 years away from retirement, yeah, you want to make sure that you're paying attention. Make sure you're not in longer term bonds, those kind of things. But if you're 10 years plus and you have money on the side and you're waiting for, the market's going to be higher. It is. I can go back and show you. The market has trended year after year after year higher, whether we're up, down, or in the middle. So now's the time. Just make sure you know what you're owning. If you need any help, reach out. But overall, God bless. I appreciate you tuning in. Sorry if it was long-winded, but I felt like it was definitely needed. Have a great day, and I hope to talk with you all soon. Take care.